Hello and welcome to Lesson 3, Stock Dividends. Over the past few weeks, we've been looking at how to interpret the stock market, how to interpret price changes by looking at charts and graphs, what happens when we have a stock split, what happens to the price. Today we are going to be looking at stock dividends. Stock dividends are just another way that you can earn money by being invested in the stock market. You know through your lessons that one way is through growth. You purchase a stock at a certain price, and over time, the price grows. You'll realize or recognize that growth once you sell the stock for a higher price. But you may also receive income from something else called a stock dividend. So today we are going to look at what is a dividend and then understand what we mean by the concept of yield. So what is a dividend? Well, a dividend is a company's excess profit. Remember that when you buy a share of stock, you own a piece of the company. So it makes sense that you should share in the profits. So the profits are paid out to the shareholders or the owners based on how many shares you actually own. Well, who pays these dividends? Well, any company with excess profits might potentially pay you some dividends. So why wouldn't companies pay you dividends? Some companies choose to invest those extra profits back into the company, into things like research and development and growth. Some companies also choose to increase their cash reserve. And some companies just don't make enough money to pay dividends. So when is a dividend paid? Well, it's paid when a company declares a dividend. Usually, companies declare monthly, quarterly, semi-annually, or annual dividends. Facebook, for example, does not pay dividends, but this is perhaps because they are investing in their company, they're trying to grow. But blue chip type companies like PepsiCo or General Mills usually pay dividends. Companies that are well established will pay that dividend. How do you know how much you are going to earn? Well, that's where the dividend yield comes in, and we'll be looking at that. What is a dividend yield? A dividend yield is taking a dividend and comparing it to the share price and expressing it as a percent. That's our yield. For example, taking what we earn in our savings account and comparing it to what we first put in, we can find out what our percent of earnings are. Here's the official formula. Make sure to write this down in your notes. So our dividend yield is taking the annual dividend, so make sure you note that. It's the annual dividend, not what is paid every quarter or every month or semi-annually, but what's paid out over the course of the year. The annual dividend divided by the current share price. So right now you should be thinking, well, the share price changes every day, and that's true. So our dividend yield calculation can be constantly changing. Then we multiply by 100, and that's so we can express it as a percent. We don't want to look at our dividend yield and say it's 0.08. What does that mean? It doesn't mean anything. But 8% means something, and that's what we can compare to other types of savings. Okay, we're now going to look at a short video about dividend yields.
Among the many factors that are considered before buying a stock, dividend yield is a financial ratio that indicates how much shareholders are paid in the form of dividends every year. It is expressed in terms of a percentage and calculated by dividing the amount of dividend by the share price. Consider this. Asset Auto is trading at 200 rupees per share and is paying an annual dividend of 10 rupees per share. The resulting dividend yield of Asset Auto is 5%. That is, the annual dividend of 10 rupees divided by the share price of 200 rupees. On the other hand, Treasure Tech's shares are also paying an annual dividend of 10 rupees per share, but its stock is trading at 400 rupees per share. Even though both companies are paying 10 rupees as dividend, you're getting more bang for your buck through Asset Auto because it has a higher dividend yield. Simply put, By investing in Asset Auto, you pay half as much for the same earnings, thereby earning more per rupee invested. Companies with a higher dividend yield could be a good investment opportunity, as a high dividend yield could be viewed as a sign of stability, as it is generally only profitable companies that pay dividends. In addition to potential price appreciation, high dividend yield stocks generally provide steady cash flows from stock investments, that is, gain in the form of dividends. The price of high dividend yield stocks tends to fluctuate less with market fluctuations. There are various mutual fund schemes that focus on building portfolios with shares of companies that have a high dividend yield. Make informed investment decisions and invest correctly.
Hopefully, after watching that video, you understand why we need to change our dividends into a yield, into a percentage, because it's hard to compare by just looking at companies and looking only at their dollar dividends. One company may pay $200 a year in dividends, another company may pay $500, but we don't necessarily know if we're getting a better deal with the $500 because maybe we paid a lot more per share than with the other company. So we always need to analyze by looking at our dividend yield. Let's look at these two companies, Company A and Company B. Company A pays $10 in annual dividends, and Company B pays $5 in annual dividends. If you only looked at the dividends, you might choose Company A to purchase. However, let's look at the dividend yield. Our share price is $300 for Company A and $35 for Company B. So remember how the dividend yield works. We take our annual dividend, so for Company A, that would be $10, and we divide that by the current share price. So our current share price is $300. Once we do that, we're going to multiply by 100 in order to write it as a percentage. So let's do that. 10 divided by 300 equals 0.03333, but if we multiply this by 100, we get 3.3%. We multiply by 100 because percent is per 100, out of 100. There's 100 pennies in every dollar. All right, let's look at Company B. Company B pays $5, and the stock price is $35 per share, the current stock price. So if we divide those and multiply by 100, what do we get? Looks like we get 14.29% if I round. 14% yield is much better than a 3% yield. If you were going into your bank and you were deciding whether to invest $1,000 in an account paying 3.3% in interest or 14.29% in interest, which would you choose? So even though Company B only pays $5 in annual dividends, it costs you a lot less to acquire that, so the yield is therefore higher. Let's look at one more example. This is a screenshot of the Home Depot from finance.yahoo.com. This is their closing price on this particular day, $77.27, and notice that the dividend and the yield have been calculated. But what we want to do is look at it as if the closing price was $77.27 today. Based on this information, what was the yield yesterday? And then let's determine the percent change. All right, so if we look up here, $77.27, remember, if we read this correctly, this arrow and this 1 means that's a drop of $1 from yesterday. So yesterday the stock price was $76.27. And we know that the dividend, the annual dividend, is $1.88. If we go ahead and set up our equation then, we take our annual dividend, divided by the current price as of yesterday, and then we can multiply that result by 100 in order to write it as a percent. So I've divided that out to get 0.024649. Then when I multiply by 100, I get 2.46%. So if you'll notice, Even though the stock went down $1, my yield is still very similar. So the yield on this day was 2.4%. Yesterday it was 2.46%. But that gives you a good idea of the type of dividend you're going to earn from Home Depot. But remember, you're not just earning dividends from the company, you will have growth if this price goes up from now until the end of the year and you sell your stock. You can also use this information then to compare between different stocks to see which company is going to pay a higher percent dividend or your dividend yield. That concludes our lesson today on stock dividends. So at this point you should understand the concept of a dividend and know how to calculate yield.